Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. Let's look ahead to the upcoming US CPI inflation report coming out on Wednesday, the 15th of May. It's going to be the big ticket item for the week from an economic perspective. And certainly this should go a long way in terms of helping markets to better gain an understanding of where they see inflation moving and whether we're going to see an interest rate cut from the Federal Reserve in the near future or further out at the back end of the year, or perhaps not at all this year. Let's get into the numbers. First and foremost, markets expecting to see a core reading of 3.7. That's a tick lower from 3.8, and the headline number remain at 3.5%. 0.3 expected on both of the monthly readings, core and headline, but certainly notable that essentially we're expecting to see inflation remain in the mid threes. Doesn't necessarily sound too encouraging for the idea that we're going to see a return to target in the coming months. The recent trajectory of inflation has been troublesome, and this highlights exactly that. I've shown you three different ways of looking at CPI inflation. You can look at it with core inflation, headline inflation. You can also strip out shelter, which is a component that some people think is too lagging and holds too much of a weighting. And all of these have been moving towards the upside if you just take the last 3 months and you annualize them out. So it's just highlighting the impact of the recent trajectory of monthly inflation. Most notable within that is the headline CPI, as you can see with that red line, big surge in terms of those recent monthly readings. And we can see that exactly here with the middle section of this chart on the right, really highlighting that recent surge in inflation. We did see the monthly reading tick down to 0.378. But as you can see here, the target rate for us to get that down to 2%, we need to be at a rate of around about 0.16. So way above that. And, you know, it's all well and good when you have some months that are a little bit over, some months that are a little bit under. But what we've seen over the past 4 months has been significantly over target, in particular last 3 months in all fairness. And that's why we've seen that massive ramp up in terms of that 3-month annualized figure. And so what we need to see is a return back down towards that target rate, 0.2 or below. Markets are expecting 0.3. So the expectation is that we continue on that above target trajectory in terms of monthly inflation. So nothing to tell us that we're going to see a big shift in terms of a move in trajectory that might signal a possible return to 2% anytime soon. In actual fact, if you look at what we're seeing more recently, we might get ourselves into a position that if we see another 1 or 2 chunky monthly readings in the headline CPI rate, then we're going to have to look towards this period, as you can see here, January, February, March. We're going to have to soon enough start looking towards that as a period that we're going to have to wait for that to be stripped out. So the possibility of waiting a year essentially to get back down towards target. Are we going to see significant disinflation in the coming months? Well, as you can see here, 0.427, that's what's being stripped out this time around. So there is a chance that we see downside in terms of that headline figure this time around. But as you can see at the top end of this, which is essentially just the headline inflation rate in the US, by and large, for the best part of a year now, a little bit less than that, you know, maybe 8 to 10 months, we've seen inflation pretty much flatlining. It's just been treading water in the mid threes, and it doesn't show any likeliness of returning down to 2%, especially given the readings that we've been seeing over recent months. And so, you know, for me, this really points towards a problem that the Federal Reserve are going to have to deal with. You know, if we look at another 0.3, which is projected this time around, then the idea that we're going to see an interest rate cut in the coming months seems a little bit foolhardy to me. But you could say, well, look, they don't just look at headline CPI, they look at core PCE alongside CPI and core CPI. So you can see here 2.8 on the core PCE number, certainly a lot closer and a lot more to target and a lot more encouraging. But nonetheless, I think there's still a way to go on that front, because if you look in the middle section here, if you're looking at, say, the orange bars, Yes, once we see April and May stripped out, there's a possibility of a little bit of disinflation on the core metric. But soon enough, you come into that phase where the June, July, August come out, and they were relatively low month-on-month figures. So there's a chance that actually we see that core PCE metric on the rise in the middle part of the year. In terms of how things are shaping up on that core figure, core CPI, you can see that the April number that's being stripped at 0.468 highlights why we're probably likely to see a touch of disinflation on that headline number this time around, which is what markets are expecting. But again, maybe next month we might also see a little bit more disinflation, possibly down by another 0.1. But maybe we get to 3.6, and then we enter that phase where, again, we're probably going to flatline for another 3 months. And then we're into September, where we might see a little bit of disinflation. So in all likeliness, core CPI is probably going to be in the mid threes come September. The PCE number maybe is a little bit below where we are at the moment. Maybe that's at 2.6. Neither of them are going to be at target at that time unless we see some really significant disinflation, which if recent months are anything to go by, we're not going to see that. So how would that potentially translate into markets? So if we see strong inflation data coming out, by and large, you see the expectations really shift in terms of where rates are going to be and the US 10-year. So expectations of higher rates by year end would point towards a higher 10-year, and that would benefit the US dollar. Now, we can see that here, the relationship between the US 10-year and the dollar index gaining ground over recent years, and we're seeing that sort of consolidation and then more recently pushing higher once again. This is a breakdown with a number of different months, so essentially 3 meetings out, 4 meetings out, 5 meetings out. You can see that we have seen a regaining of ground over the course of this year, really. That has been tempered a little bit recently with the weaker than expected payrolls and sort of jobs report over in the US, which did provide a little bit of a boost to markets and a little bit of weakness for the US dollar. But by and large, the trend that has been playing out over the course of this year thus far has been one that has been dominated by the expectation of interest rates remaining elevated for an extended period of time, born out of inflation data that has been higher than we need it to be. And I've highlighted exactly that. The inflation data that we've seen over the past 3 months point towards the possibility of us not even cutting interest rates this year, quite frankly. And so if we see another 0.3, 0.4, 0.5 this month on the monthly figure, then that would point towards all of these lines moving towards the upside. And if we see upside in terms of the 10-year, then we'll likely see upside in terms of the US dollar index. This is the September meeting. This is one of the meetings where we've seen significant movement around in terms of expectation. So a month ago, there was pretty much no chance that by September, markets were, maybe it's 10%, less than 10% that markets were pricing in for a possibility that we keep rates as they are now. Well, in actual fact, that's roughly around about 30% now. The base case scenario is that we see a rate cut in September. So that is better than, certainly on certain metrics. Other places we've been seeing a possibility of a December rate cut as being the first one, and we, been looking for that to have been brought forward, say on the Icon platform by LSE Group. That pushed out to December. Now it's been brought back into November. But as a highlight, I think there's a good chance that we keep above 2% target across those major inflation metrics for some time yet. And therefore, I think there's still a possibility that we see this pushed out further and pushed back into that no rate change scenario that we can see on the right hand side here. At the moment, markets are pricing in a roughly 30% chance that we don't see a rate cut in September or before. And I think the likeliness is higher than that because inflation's not going to be at that level that they need it to be by September, or certainly I believe that that is not going to be the case. So how might we look at markets? Well, first and foremost, let's bring up the S&P 500. As you can see here, it's really been on a charge lately. Let's just overlay the US 10-year to see how this is relating to market expectations. So we can see here that the relationship has been relatively choppy. You can see that the gains that we've seen over the course of this year for the US 10-year have not really hindered the likes of the S&P 500. In actual fact, they have gone hand in hand. Then all of a sudden, we saw markets finally rolling over off the back of that in April. But it's not necessarily lasted particularly long. In actual fact, we've seen that relationship turning around in the fact that we've seen yields rolling over, and therefore we're seeing equity markets moving higher. So we do have this interesting position where we see inverse correlation coming into play at the back end of last year. We move into 2024 into a positive correlation. We've now moved into an inverse correlation once again. As you can see here, if I was to invert it, you can see we're now in a positive inverted correlation. It shows as positive here, but it's inverted. So what does that mean? Well, it means that if we're expecting to see the possibility of, so if we see strong inflation data, we're likely to see the 10-year moving higher once again, and that could put downward pressure on equity markets. Similarly, if we see a low inflation gauge and we see, comments coming out of the Federal Reserve that might indicate that we are going to see an interest rate cut in the coming months, then it's likely that would drive down the 10-year, and likely the S&P 500 will move higher once again. But this essentially, for me, does highlight that there are significant concerns around this recent rally. We're coming out of earnings season, largely unscathed with the fact that we're so close to those prior highs. But that also means that markets are likely to focus more on what's happening in terms of the economic side of things. And I think that there's significant concerns around the US inflation picture. Here's the 10-year overlaid with the US dollar index, as we can see here, regaining ground over the course of this year, but then starting to pull back recently. That pullback driving down the US dollar index. And so, the question mark is whether this sort of pullback that we're seeing in the 10-year is just akin to this trend that we have been seeing. And I think that is likely, because I think markets are currently pricing a September rate cut that I think there's a good chance we don't see happen, in which case that could drive a move towards the upside in terms of the 10-year if inflation data really highlights that to be the case. So if we see a potential move towards the upside for the 10-year, then that's pointing towards possible upside for the dollar index. As we can see here, if we were to take away that overlay, you can see that we're sort of pulling back at the moment, sort of rolling over, potential bearish engulfing coming into play here. But ultimately, we've got this wider trend in play. And so whether we come back into trendline support before we see the bulls coming back into play, or whether we're just looking at a sort of deeper Fibonacci retracement to come into play here, possibly there's 1044 kind of area. However it plays out, I think there's a good chance that if we see that inflation data do anything other than, move significantly lower, it could be a warning sign. And that could therefore spur another move towards the upside for the US dollar index. So possibility of some weakness as we head into the report. But certainly I think the report is going to be really key in terms of providing some clarity over expectations for interest rates. And I think there's a distinct possibility that we see the US dollar bulls coming back into place soon enough. Bear in mind, you can see that this dollar index has been very choppy over the course of the past year and a bit. And we have rallied back up towards the top end of this consolidation. But it's not necessarily a sort of perfect consolidation. It's not it's not a perfect range or anything like that. So I wouldn't necessarily say that, it has topped out, because ultimately markets at the moment, I think, are relatively optimistic. And I think inflation is showing itself to be a big problem. So I wouldn't be surprised to see the dollar index coming back into some buying pressure down the line once we see this inflation data reported. And finally, this is the price of gold with the 10-year overlaid. So what are we seeing here? Well, the 10-year has essentially, let me just get the daily time frame. The 10-year at the moment is tracking in a positive correlation to the price of gold. So as we see the 10-year pulling back, i.e. expectations for a rate cut over the near term, as we see that pulling back, we're seeing gold pulling back. But then if we potentially look for another move towards the upside for the 10-year, that might point towards a rally for gold once again. So look, these relationships are not always 100%, I wouldn't say reliable, but they're not always 100% positive or negative, as you can see here, right? We've got a negative correlation here throughout this period and this period, then more recently moving into this positive correlation. So it's really interesting seeing how these correlations between different markets change over time. But as things stand, the relationship between the 10-year and gold looks positive. And if we're looking for a possible warning sign for markets with a strong inflation gauge, if that comes out, we look likely to see the 10-year moving towards the upside, and that could put upward pressure on gold once again. To some, that might not necessarily make sense because, of course, we'd be looking for dollar strength as well, but that's how it has been playing out thus far of late. So there's a possibility that we see more of the same. But certainly from a long-term perspective anyway, I think gold remains an outperformer. It has been doing very well. And the rally that we've been seeing of late, as we see here, looks to potentially draw a line under this sell-off that we've seen. Certainly a move up through this near-term resistance level of 23.52 would give greater confidence that that pullback phase is over and that the wider long-term bull trend can potentially come back into play once again for gold.